Hello SD Bullion YouTube subscribers, my name is James Anderson. This is our third SD Bullion gold and silver market update. Mixed price action for the major four precious metals this week. The spot silver price is closing just over 17 per troy ounce. Spot gold price closes the week at $1,465 per troy ounce. The spot platinum price climbed a couple of bucks to finish $895 per troy ounce. And the spot palladium price has the most upside of the four precious metals this week. As lease rates in London are again climbing, signaling physical palladium shortages ongoing. Palladium is ending this week around 1,780 per troy ounce. It's not far from its recent record high. And finally, the gold-silver ratio ends this week with just over 85 ounces of silver to get 1 ounce of gold. Last week we focused in on the Federal Reserve's balance sheet now having ballooned almost $300 billion since the middle of September 2019 when the New York Fed's repo loan program started. This week, I would like to take us back to hear yet more U.S. Congressional testimony from Federal Reserve Chairman Jerome Powell, who again spoke to U.S. Congressional Joint Economic Committee roughly 10 days ago on November 13, 2019. In the following clip, Powell speaks about the unsustainable debt-driven path that the U.S. is currently on, with hard federal debt now past $23 trillion, a few trillion more than our annual GDP. There will be no mentions of unfunded liabilities or other promises we have not saved for, such as Social Security, Medicare, pension liabilities, unfunded private debts, or other mandatory unfunded government debts. The total of that is currently estimated anywhere from 100 to over 200 trillion, depending on your estimation source. Without further ado, here is the private Federal Reserve Central Bank Chairman Jerome Powell.
Some have suggested that because we in the United States, that the United States government borrows in its own currency, this level of spending isn't a problem because the Fed can just monetize the debt and keep doing so more or less indefinitely. Well, what's your reaction to that talk? Are there risks inherent in it?
Yes, no, as I mentioned in my testimony, the fact that interest rates are lower does mean that we will pay less in interest. It does not mean that we can ignore deficits at all. We're going to have to get on a sustainable path. What does that mean? So the debt is growing faster than the economy. It's as simple as that in nominal terms. And that is, by definition, unsustainable. Ultimately, you will have to get it to where the debt is not growing faster than the economy. And it's growing faster in the United States by a pretty significant margin. So even with lower rates and even with decent growth, there's still going to be a need to reduce these deficits.
Speaking of debt growing faster than the U.S. economy, total global debt is growing faster than the global economy. The Institute of International Finance updated the world's new record high hard debt promised pile to now over $255 trillion in fiat Federal Reserve note terms. This data does not take into account the aforementioned unfunded multi-hundreds of trillions in promises, not merely that the U.S. has made, but also other Western governments who are all readying to default, one way or another, via currency debasement or structural resets in the coming decades. A couple quick back-of-the-napkin points for you to consider in terms of these fiat debt piles versus physical gold values worldwide. In 1999, all the physical gold then in the world was about 130,000 tons, worth in total about 1/100th of the then worldwide record debt level on this chart. Today, in 2019, all the physical gold that is in the world, it's about 193,000 tons. It's worth a total of about 1/28th of this new worldwide record debt level. The trend of further fiat currency devaluations, more nominal debt piles higher, and gold gaining further value still against it all is unlikely to revert in the 2020s and even into the 2030s. For a little bit more coloring on the story, let's go over to Miss Shedlock's blog. He had pretty interesting insights into this. I wanted you to hear what he had to say. He writes, global debt just popped $250 trillion. Please ponder paying the interest on that, let alone the principal. He says, please note that global debt surged to a record $250 trillion in the first half of 2019, led by US and China. Global GDP numbers from the World Bank say that to get a $1 rise in GDP, it takes about a $3 rise in debt currently. Things keep pointing back to 1971. And on a side note, that anyone that's paid attention to what happened in 1971 up until today knows that Nixon's cutting off the US dollar from gold essentially led off this fiat currency orgy that we're currently living under. Mish writes, Since the dollar is rising thanks to European, Japanese, and Chinese tactics, it may take even bigger U.S. deficits before something major breaks. On that score, both political parties in the U.S. are poised to deliver increasing deficits, as far as the eye can see. Meanwhile, negative interest rates are destroying European banks. He also states that $250 trillion in debt, how is it ever going to get paid back? He expects an uncontrolled collapse of a major currency, debt market, or bank system that cannot be funded. He says it's hard to say where it starts, but he doubts it starts in the U.S. Chinese and European banks are in far worse shape than the U.S. banks. European banks are getting hammered by negative rates. Japan still struggles with decades of Abenomics. The Fed and central banks brought this on by refusing to let zombie banks and corporations go under and insisting on cramming more debt into a global system, choking on debt. But this all has its roots in 1971. Central banks are the enablers, but Nixon's shock set it off. A currency crisis, it awaits, but the timing and conditions of the crisis are not knowable. It can start anywhere. But Mitch suspects the EU, Japan, or China, as opposed to the US, is where it will start.
It's a longer-term issue that I imagine we all realize will have to be addressed over time. It's just the case that now that the debt is growing faster than the economy, than the nominal GDP. And ultimately, in the long run, that's not a sustainable place to be. Now, how to fix that? It's easy to say that, and how you do that and when you do that is an issue that is up to you and not to us. But I would be remiss in not pointing out that the consequences of not addressing it are just that we'll be spending more and more, our kids really and grandkids, they'll be spending their tax dollars servicing debt rather than on the things they really need. As I mentioned earlier, education, healthcare, security, all the things that we need, that they'll need. They'll be spending more and more of their money on tax. But you don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt. And that should be I think, the goal. And by the way, the successful programs for countries to get back on a sustainable path tend to take place over a long period of time and be relatively gradual. And I would be looking at something that would work over time, but really would not be giving you a lot of advice on how to do it.
One tactic that's already been put into nearly 40 years of use is how the federal government's Bureau of Labor and Statistics, BLS, has been increasingly lying to everyone about true price inflation rates, now coming on almost 4 decades. Note the multi-decade gap between the red line and the Fed's currently "we don't have enough inflation 2% lies," the blue line's more accurate inflation statistics. You well know this because most likely you've paid some form of increasingly higher hospital, healthcare, childcare, and educational costs over the same time frame. Prices which in less and less way matched what you were being told about regarding the Federal Reserve notes purchasing power. Their systematic inflation lies began as policy after gold almost took the entire financial system down in January 1980. And since the 1990s, about 7 to 5% per year compounding inflation lies between the real inflation number and their lying statistics have basically decimated the entire U.S. middle class, as median wages have been stagnant and in real terms dropping for decades. To put this in context, most listeners and viewers can better understand, let's look at silver under the context of how we used to measure inflation before 1980. The near 50 fiat Federal Reserve note price high for silver in late April 2011 is now worth over $100 per ounce in today's fiat Fed notes. The 1980 price high looking backwards, if I even muttered it, would make me sound like a silver bull nut job. The reality of monetary precious metals over time is that they simply buy more of other commodities long term. The opposite is the case for any fiat currency. Even though we human beings get more productive producing more output per man hour decade after decade, every fiat currency note will keep losing value to real things over time. The fiat Federal Reserve note is no exception. Our own U.S. history shows us that without central bank interventions, price fixings, war-induced price inflations, or unconstitutional fiat currency issuances, the general state of our history is one of goods, services becoming cheaper to gold over time. A couple of positive pieces to end this week's update. From Financial Twitter, for our FinTwit tweet of the week, we go to Peter Spina, the purveyor of SilverSeek.com and GoldSeek.com. Peter tweets, "I own more gold than the Central Bank of Canada." And that's true. The Central Bank of Canada has 0 official gold reserves. While they may have a lot of gold in the ground, and there may be a lot of gold sitting over at the Royal Canadian Mint, On an official capacity, if you have 1 ounce of gold, you got more gold than Canada. And finally, a sixth trader of precious metals over at JPMorgan got busted using the RICO Act again. It looks like the Department of Justice charged another former JPMorgan Chase and Company executive with alleged racketeering and manipulating of precious metal prices. This time occurred from 2008 to 2017, almost 10 years. Jeffrey Ruffo. Jeffrey Ruffo worked at JPMorgan for almost a decade, serving hedge funds, investing in precious metals, and then he encouraged JPMorgan traders to place deceptive orders to create price advantages for him and his clients. The indictment also alleged that Ruffo and his former colleagues defrauded JPMorgan's clients who had invested in barrier options by pushing option prices to levels that benefited the bank. None of this is surprising for anyone who's actually been paying attention over the last decade with JPMorgan and the way it's acted in the precious metals markets and other major commercial banks. These are all allegations. No one has been completely... Ruffo is going to obviously fight these charges, but there goes another JPMorgan trader charged with RICO Act, which is essentially racketeering conspiracy, and it's usually associated with organized crime. Hey, thanks for tuning in. If you liked it, be sure to like the video. If you haven't subscribed to our channel, do that. And also hit the alert button so you don't miss these market updates as they come along. Give me a comment below. Let us know what you think and what you'd like to see more of. Have a great weekend, everyone. Thanks for tuning in.